Hi, welcome to all. So in this tutorial, we are going to discuss about the leverage, capital structure, solvency and earning coverage. So as you remember in the previous discussion, in the previous session, we have discussed about the liquidity. Liquidity is the ability of a company to meet its short-term obligation, but when it's come to leverage, leverage is the ability of a company to meet its long-term obligation, long-term fixed payment, long-term repayment. Again, its capital structure, its solvency, how the asset is financed, whether it is with the equity or without external debt, or these analyses are happening with the leverage ratios. So let's get started. The first one, leverage. Leverage means how a company use borrowed fund and fixed cost to magnify return. As you know, the companies can get external fund or borrowed fund, but this fund has to be effectively used and manage to magnify the return. Otherwise, what will happen? There is a big financial risk also with related to this borrowed fund. So it should be properly managed and analyzed. The next term, capital structure and solvency. Capital structure means the mix of debt and equity when company used to finance its asset. And also solvency means its ability to meet its long-term obligations. Again, the earning coverage. Earning coverage means its company ability to pay its fixed financing cost from its profit. If a company raised a borrowed fund, there should be a fixed financing charges like interest. If it is a lease, there is a monthly lease payment. So is this earning coverage ratios measure company's ability to pay these fixed costs from the profit. We will move into financial leverage in detail. Financial leverage refers the use of debt fund to finance the asset. So, borrowed capital or debt fund to finance the asset. The goal is to generate return on this asset that are higher than the cost of debt. That means we borrowed a fund, there should be a fixed charge for that fund. So the return from that fund or return from that investment should be higher than that cost. Then only we can amplify the return to shareholders. If the return from that asset is lower than the capital cost of capital or cost of debt, it should amplify the loss, not the profit. When successful, this amplifies the return up to shareholders. It's also amplify losses if returns are lower than cost of debt. So when successful, it can amplify the return because the return from that asset should be higher than the return of cost of capital or cost of debt. If the opposite things happen, that means the return from that asset is lower than the cost of capital, it can amplify the losses also. So that should be it's an opportunity. Again, there is a related risk also there with the financial leverage. This is a financial leverage rate. It measures how much proportion are leveraged, how much leverage fund we are used to finance the assets. So the formula for this ratio is total asset divided by total equity. You can look into this example. A company has total asset of 2 million and the total equity of 800,000. So in this case, the financial leverage ratio is 2 million divided by 800,000. That means 2.5. What is interpret? Is interpret that every single dollar of equity the company has $2.5 in asset. That means in this case, the $2.5 asset out of $2.5 asset, every $1 is financed by equity and every $1.5 is financed by debt. I'm repeating, the financial leverage ratio in this case is 2.5, which means that just assume if a company have $2.5 in asset, every $1 of 2.5 is asset financed by equity and every $1.5 of its asset financed by debt. So this is how we are analyzing and calculating the financial leverage ratios. Now the degree of financial leverage. Degree of financial leverage, the sensitivity of company earning per share to changes in its earning before interest and tax. It quantify the magnification effect using debt. For example, how sensitive our EPS with related to earning before interest and tax. So the formula for degree of financial leverage is, there is two formulas are there. The first one, percentage change in EPS divided by percentage change in EBIT, or EBIT divided by EBIT minus interest. We can look into this example. In this case, there is an EBIT of 500,000 and annual interest expense is 100,000. So in this case, the degree of financial leverage is 500,000 divided by 400,000. That means 1.25. So what it means that if we made 1% change in EBIT, it could lead to 1.25% changes in EPS. Changes mean both positive and negative. If the EBIT is increased by 1%, it could lead to 1.25% increase in EPS. The same time, if EBIT is reduced to 1%, or let's assume 10%, again the EPS will reduce by 12.5%. That means this is telling the proportion or ratio of how the changes in EBIT is affecting EPS, earning per share. This is happening due to that fixed interest expenses. Again, the fixed expense is always fixed. If you are doing better EBIT, the interest will be fixed. And if you are doing the lower EBIT, again the interest will be fixed. So this is due to that fixed interest expenses. So if you can create more EBIT into business, again the interest remain fixed. So it will lead to higher changes or higher positive impact in earning per share. Now we'll move into operating leverage. So this is about financial leverage and calculation of financial leverage and degree of financial leverage. Now we'll move into operating leverage. Operating leverage related to proportion of fixed cost within a company's cost structure. A company with a high operating leverage. Example, heavily automated manufacturing plant with high depreciation and rent. We'll see large percentage change in operating profit with a small changes in sales. Just assume if a company is highly automated and its variable cost is lower and or its manual work is lower and is highly automated with the high-end technologies, so obviously the depreciation and rent will be higher for that manufacturing facility. So if we do more sales, mean that increase the sales, it can have a big impact in operating profit. That means if a company is highly leveraged its operation, which mean a small changes in sales can have a big impact or large percentage of change in operating profit. Here the degree of operating leverage. Degree of operating leverage measures the sensitivity of a company's EBIT to changes in sales revenue. It shows how a changes in sales get magnified into large change in operating income. That means how a changes in sale or even a small changes in sales get magnified into a larger change in the operating income. These all things happening due to that fixed cost element. So if you are leveraged, if you are operationally leveraged, your fixed cost will be higher and your variable cost percentage will be lower if you are comparing with a non-leveraged company. So the formula for operating leverage formula for degree of operating leverage, percentage change in EBIT divided by percentage change in sales, or contribution margin divided by EBIT. So how we can calculate contribution margin? Contribution margin is equal to sales minus variable cost. So we'll move into an example. This is a company example. This is an example. That means there is a sale of 1 million. Variable cost is 400,000 and fixed cost is 300,000. So how we can calculate the degree of operating leverage? The formula for degree of operating leverage is contribution margin divided by EBIT. So first we have to calculate the contribution margin, that sales minus variable cost. While 1 million minus 400,000, that is 600,000. So next thing we have to calculate an EBIT, enemy for interest and tax. That means you have to reduce, for EBIT, you have to reduce all these variable costs and fixed costs from the sales revenue. So in this case, degree of operating leverage is equal to 600, that is our contribution margin, divided by 300. That's our EBIT. That means 2. So what it means that if we have increase or there is a 1% of increase in sales can leads to 2% of increase in EBIT. This high sensitivity is due to its significant fixed cost. Because the company have a big fixed cost, it's always fixed. When activity level change or increase or decrease, it's always fixed. So in this case, if we increase the activity level or increase the sales, it can have a big impact or the larger proportion of changes in EBIT. Total leverage is combines the effect of both operating and financing leverage. It measures the total sensitivity of a company's EPS to changes in its sales. It gives a complete picture of a firm's risk profile from both its operational and financing cost. That means it's measuring the changes in EPS, earning per share, when changing the sales. So the degree of total leverage, there is a formula for degree of total leverage. The first formula is, there are two formulas. The first formula is degree of operating leverage into degree of financial leverage, or degree of total leverage is equal to percentage change in EPS divided by percentage change in sales. The changes in sales, how it is affecting in EPS. If it is highly leveraged, that means a small changes in sales can lead a high impact in the EPS. Even in the companies, if there is no leverage, so the changes in sales can have a same effect in the EPS. So here is an example. That means that there is an annual interest expense 100,000. So same as the previous example, we are continuing. Annual interest expense is 100,000. Sales 1 million. Variable cost 400,000. Fixed cost 300,000. So we are going to calculate the degree of total leverage here. So the degree of total leverage, the formula is degree of operating leverage into degree of financial leverage. So in the same case, we already calculated degree of operating leverage. It is 2. So now what we have to do, we have to calculate the degree of financing leverage. So degree of financial leverage, the formula is EBIT divided by EBIT minus interest. So the EBIT, that is 300,000, that means 1 million divided 1 million minus 400 minus 300, that is EBIT. Now EBIT minus interest, that means 300 divided by 200, that will be 1.5 is the degree of financial leverage. So here in this case, the degree of total leverage is, the formula is degree of operating leverage into degree of financial leverage. That means 2 into 1.5, that means 3. So here what we can interpret this degree of total leverage, which means if there is a 1% change in sales, it can lead 3% change in EPS with the effect of financing leverage and operating leverage. If the company have 1% change or impact or increase in sales can lead 3% change or increase in EPS. This shows the combined magnification effect of both fixed operating costs and fixed financing costs. So as you know, the fixed financing cost and fixed operating cost is always remained fixed. So this is the reason for this magnification effect, because if there is a increase in sales can lead more impact in the EPS, earning per share, if the company is leveraged. Now we will move into capital structure. Capital structure simply means how company finance its asset, whether it is with equity or whether it is with debt. It refers to a specific mix of debt and equity a company's use finance its assets and operations. The solvency is the company's ability to meet its long-term obligation. These ratios are crucial for assessing long-term financial health and risk. So in the capital structure, there are some important ratios are there, like debt equity ratio. The formula for debt equity ratio is total debt divided by total equity. We can discuss with an example. So in this example, There is a total asset 1.5 million, total liability is 900,000, total equity 600,000. So in this case, the debt equity ratio is 900 divided by 600, that is 1.5. So how we can interpret this? So in this capital structure, there is $1.5 of debt for every $1 of equity. That means if the debt equity ratio is 1.5, mean there is a $1.5 of debt for equal to every $1 of equity. Which means if a company's debt equity ratio is higher than 1, which indicates that the company is financed more with debt than equity. If it is greater than 1, it is financed with more debt than equity. If it is less than 1, the more equity is used to finance the business. So this is how we are interpreting the debt equity ratio. Now we will move into next ratio, that is long-term debt equity ratio. Long-term debt equity ratio is always similar to debt equity ratio, but here in the debt we are considering only the long-term debt, not the short-term. So in this case, the formula for long-term debt equity ratio is long-term debt divided by total equity. So we can go to an example. Just assume that we have a total liabilities of 900,000. We are continuing with the previous example. So just assume that the total liabilities of 900,000 includes 750,000 of long-term debt also. So in this case, we are calculating long-term debt to equity ratio, long-term debt divided by total equity. So in this case, the long-term debt is 750,000 and equity we already see in the previous example, it is 600,000, that means 1.25. So how we can interpret this? Which means if the company has $1.25 of long-term debt for every $1 of equity. Now we will move into next ratio, that is debt to total asset ratio. The formula for debt to total asset ratio is total debt divided by total assets. So again we are using the same previous example. In this case, the total debt is 900,000 and total asset is 1.5 million. That means 0.6 or 60%. So what we can interpret from this example, that means 60% of these companies' assets are financed by debt. The creditors have a claim on 60% of company's asset. That means 60% of total company's asset are financed by using debt. So this is about the debt to asset ratio. So if it is higher, that means the debt is higher. That means more proportion of asset is financed by using debt. If it is lower, that means the debt proportion in the asset is lower. That means the only small proportion of asset is financed by using the debt. Now we will move into the earning coverage ratios. Earning coverage ratios are the ability of a company to make fixed contractual payment, such as interest or lease payment, out of its operational earnings. A low coverage ratio can be early warning sign of financial distress. By using company's operational income, how many times the company can pay off its fixed charge like interest and lease payments. This is earning coverage ratio. So the first earning coverage ratio is interest coverage ratio or times interest earned. This formula is most common coverage ratio. It indicates how many times of a company can cover its interest payment using its operating earnings. Normally, lenders pay very close attention to this ratio. That means EBIT divided by interest expenses. That means how many times the company can pay its interest expenses by using its EBIT. If the ratio is higher, that means the company have more ability to pay its interest expenses. If the ratio is lower, which means the company have only limited ability to pay its interest expenses. So we can go through a case. Here the EBIT reported 750,000 for the year and the interest expenses outstanding loan was 150,000. So in this case, the times interest earned is 750,000 divided by 150,000. That means 5 times. So how we can interpret this example? This company's operating profit are 5 times of amount needed to cover the interest obligation. This normally we can consider as a strong ability to meet its interest payment and is generally considered a healthy ratio. Again, these ratios, the benchmark of this ratio can be vary from industry and the company to company. So normally the 5 times mean considered a healthy ratio. That means this company have operating income or EBIT to cover 5 times of its interest expense, that is times interest earned. Now we will go into fixed charge coverage ratio or earning to fixed charge. So this total fixed charge coverage ratio is more comprehensive than times interest earned because it includes other fixed charges also that are similar to interest. For example, the lease payment, if the sum of the asset is financed by using lease, there will be a monthly or periodic lease payments. So these lease payment or similar other fixed charges also considering in fixed charge coverage ratio to measure the financial health. So the formula for fixed charge coverage ratio is EBIT plus lease payment divided by interest expense plus lease payment. So we will move into a case. So in the same previous example, just assume that there is a lease payment of 50,000. So we have to add the lease payment to operating income. You have to add EBIT plus lease payment divided by interest plus lease payment. So in this case, the coverage ratio is 4. That means 750. To 750, we are adding the lease payment and we are dividing that with interest expense plus lease payment. So the values will be 800,000 divided by 200,000. That means 4 times. Which means this company have operating income to cover 4 times of its total fixed charge. So when we including this payment, the company's coverage drop from 5 to 4. Again, this can be considered as a healthy ratio because the company have the ability to pay its total fixed obligations 4 times by using its operating income or EBIT. Total fixed charge coverage ratio provide a more conservative and complete picture of the company's ability to meet all its fixed obligations. The times interest earned, we are considering only the interest expenses as the fixed cost, but in the total fixed charge coverage or fixed charge coverage ratio is considering all fixed cost including interest, or is there any other fixed payment like the lease payment also considered into fixed charge coverage ratio. So this provide a more conservative and complete picture of the company's ability to meet all its fixed obligation. Now we will move into cash flow to fixed charge coverage ratio. Normally the times interest earned or fixed charge coverage ratio can be mislead because the EBIT is an accrual based figure, not the actual cash. In this cash flow to fixed charge coverage ratio, we are using total cash flow. We are comparing the total cash flow with the fixed interest or fixed charge payment to see how many times it is covering the total fixed charge. Earning based ratios like times interest and can be misleading because EBIT is an actual base figure, not actual cash. A company could have EBIT high but poor cash flow. Now the cash flow to fixed charge coverage ratio uses cash flow from operation is more reliable indicator of a company's ability to generate cash to pay its bills. So the formula for cash flow to fixed charge coverage ratio is cash flow from operations plus interest plus cash tax paid divided by cash interest paid. So we will look into an example. So in this case, the cash flow from operation is 1.2 million and the cash paid for interest is 200,000 and cash paid for tax is 300,000. So the formula is 1.2 million plus 200 plus 300 divided by 200,000. That means 1.7 million divided by 200,000. That the answer, the cash flow coverage ratio is 8.5, which means the company can pay 8.5 times of its total fixed charge by using its operating cash flow. The cash flow incorporates generally enough cash from its core operation before interest and tax to, to cover its interest payment 8.5 times over. That means this company can pay its interest expenses 8.5 times by using its operating cash flow. This provides a strong assurance of its ability to serve its debt from actual cash flow, not just accounting profit. So in the cash flow ratio, it is mainly considered the actual cash inflow rather than the accounting profit. So it provides a real ability of a company to pay its debt by using its cash flow. So this is about today's discussion. So what we discuss is mainly the leverage ratio, times interest and capital structure, and solvency. These are the important part in the CMA USA examination. I'm providing the downloadable link of this PDF work, this PDF presentation to you, so you can download and use that file for free. Thank you for watching this video.